So portfolio management may be defined as a process of construction, maintenance, revision and evaluation of a portfolio. So portfolio management involves in ensuring sufficient liquidity in the portfolio to meet the short-term cash flow needs and to meet the unexpected expenses. So using the sharp single index method, construct the efficient frontier which represents the set of optimal portfolio that offer the highest expected return of a given level of risk. Hello students, how are you all? I hope so you're doing good. I welcome you to the investment management session. In today's session, we are going to talk about portfolio management. So before I start with the topics, let me give my introduction. I'm Vaishnavi, Faculty of Commerce from Vidhyaashram First Grade College, Temple of Excellence, MYSURU. So we'll see the topics today that we are going to discuss. So first we are going to talk about what is the meaning of portfolio management, need for portfolio management, then objectives of portfolio management, process of portfolio management, then construction of an optimal portfolio using the Sharpe's index method, then portfolio performance evaluation. So all these are the topics that we're going to talk about in today's session. So let's start with the meaning. Yeah. So the meaning of portfolio management in brief, I can tell you that it's the managing of your different investments portfolios. That means the different investment projects, or you can also call it as a portfolio, is all about a portfolio management. So we'll see the meaning. So portfolio management may be defined as a process of construction, maintenance, revision and evaluation of a portfolio. So under the management, so what are all the steps you are going to get? First step is construction, then maintenance, then revision and evaluation of a different portfolios or projects, investment projects will be called as a portfolio management. So the basic objective of the portfolio management is to build a portfolio which gives a return commensurate with the risk preference of the investor. So it is about like having the highest returns or high returns with the less risk preferences. So portfolio management specifically deals with security analysis and selection of portfolio, revision and of portfolio and evaluation of portfolio. So what are all the main basically the portfolio management is going to talk about? It is about the analysis of the different portfolio, selection of portfolio and revision and evaluation of a portfolio. So this is the basic meaning of it. So we'll check with the what is the need for portfolio management, and that first is risk management. So you know that like any kind of an investment opportunity or project will be handling the their kind of a risks. It might be a low risk, high risk, moderate risk or very high risk, etc. So based on that your investment projects will be also getting the returns on it. So it is important to analyze what is the risk and what are the kind of losses that you're going to get on the investments that you have made. So with the help of the portfolio management, you can analyze or you can predict or you can forecast the future changes in the prices of the commodities or securities or stocks, which will helps you to minimize your risk. So in case of the risk management, it helps in diversifying the investment of different assets, industries and geographic regions to reduce the overall risk of a portfolio. So if the one investment, if it has been poorly performed, it balances out by the other kind of well performing portfolios. Next need is optimizing the returns. So through a profit portfolio management, investors can strategically allocate their resources to maximize the returns, which in considering the risk tolerance and investment goals. So one more need for portfolio management is what? To maximize the returns of the investment portfolio and to decrease or to hinder the risks of the investments that the investor is going to face. Next need is aligning with the goals. So what kind of goals? It is about the financial goals. So effective portfolio management ensures that investment aligns with the individuals or organizational financial goals, whether it is wealth accumulation, retirement planning, funding a project or other objectives. So each and individual will be having different types or different kind of goals, financial goals especially. So based on that, a portfolio management will be aligning, and it helps you to reach your financial goals after a period of time. Next is monitoring the performance. So portfolio management involves in continuous monitoring and evaluation of investment performance. So it's a basic work, or the basic meaning of portfolio management is what? To construct, to maintain, to revise and to select such kind of portfolio. So always there is a monitoring or controlling over the performance of the stocks or securities or investments that are made by the investors. So next is about adapting to the market changes. So market changes are dynamic, and portfolio management enables the investors to adapt to the changing market conditions, economic trends and regulatory environment. So depending upon the market trends, depending upon the political environment, depending upon the external environments, all you can take, all those comes under the adapting the marketing changes. So if there is a slight changes in any such kind of investment decisions or any kind of management plans being made by the company or the industry, so that affects the stock prices. Okay, so that is why adapting to the portfolio management will always helps you to adapt to the market changes. So next topic is about objectives of the portfolio management. So under that, first is about maximize the results. So why we are been doing all this, like analyzing, forecasting, understanding, constructing all the securities, how they have been performing, why we are all doing it. So the main objective is what? To maximize the returns on the investment. So as of now, the objective of the portfolio management, the main objective is what? To maximize the results or to maximize the returns on the investments that you have made. So it's the main objective is to maximize the returns investment while considering the level of risk an investor is willing to take. So portfolio management will strive to achieve the highest possible returns within the constraints of a risk tolerance and investment objective. Next objective is what? To manage in the risk, that is risk management. So portfolio management aims to manage the risk effectively by diversifying the investments across the different asset classes, industries and geographic regions. So the diversification helps in reducing the overall risk of the portfolio and minimizing the impact of adverse market movements in the investment returns. So how the risk is being managed? So they will be analyzing all the different types of securities, economical conditions, political conditions and also the overall worldwide economical and political conditions will be analyzed, and those kinds of risk will be hedged or will be passed on or will be sold or will be maintained with the other kind of a high returning kind of a portfolios or high returning investment options. So by that, the risk can be balanced and the losses can be reduced by the investors. Next objective is capital preservation. So another important objective is to preserve the capital, especially for the investors with a low risk tolerance and nearing the retirement. So when the investor, the main objective of an investor is what? To have the money during the retirement age. Okay, during that time individual cannot work and he cannot get the stable income. So that is the reason why during the retirement age, so the particular person or individual will be investing now so that they can enjoy their retirement age. So it is about like the main objective is what? To capital preservation, to save the capital and to minimize the risks of the investments. So next is about liquidity management. So portfolio management involves in ensuring sufficient liquidity in the portfolio to meet the short-term cash flow needs and to meet the unexpected expenses. This includes maintaining a balance between liquid assets and long-term investments. So one more objective is what? To maintain the liquidity management. Unexpected risks or unexpected expenses will be coming on a businesses as well as to the personal individual as well. So the main objective of the portfolio management is what's to face those kinds of risks and to make sure that to face that kind of unexpected expenses that you get. So next objective is optimal asset allocation. So the objective of optimal asset allocation involves determining the right mix of assets, that is mixture of stocks, bonds, real estates, alternative investments, etc., based on the factors such as risk tolerance, investment horizon, and market conditions. So one more objective is what? Not just only investing on one kind of an investment opportunity. So it's better to invest on different types of the investment opportunity, like we have got stocks, bonds, preference shares, mutual funds, insurance, etc. So if you invest in all those based on the risk tolerance and based on the maximizing the returns, so there will be a mixture of capital that will be invested by the investor, so that to reduce the risk and to increases the returns. So these are the objectives of the portfolio management. So next we'll talk about what is the process of the portfolio management. Under that, first is identification of the objectives. So depending upon the businesses, depending upon the individual perception, so the objectives will be changing on, financial goals will be changing on. So first step is here what? To identify your objectives, that is your financial goals. Second step is what? Estimating the capital market. So that is how the market currently is being there. So whether it is on upward or downward, or whether it is stable or whether it is unstable, all this needs to be analyzed here. So expected returns and associated risks are analyzed to take necessary steps here. So analyzing the capital will be leading to the expected returns and to reduce the risks of the investment options. Third step is decision about the asset allocation. So that I have discussed in the previous slides, asset allocation is what? To have a mixture of the assets, that like stocks, like debentures, mutual funds, insurance, fixed deposits, etc. So how you are going to allocate your capital, based on that you can make a decisions on in where and where you want to invest in order to get the maximum results. Then step 4 is formulating the suitable portfolio strategies. So that means understanding the performance of the stocks or securities or market, and based on that you can buy and sell, and you can play the such kind of strategical or tactics, so that the risks can be tolerated. So next, fifth step is selecting of profitable investment and securities. So after you have analyzed the market, after you have analyzed the fundamental analysis, after you have made the technical analysis, next step is what? To select the profitable investment and the security portfolios or projects. Then sixth step is implementing of the portfolio. So that means purchasing of such portfolio projects, like I have told, stocks, debentures, commodities, derivatives, mutual funds, insurance policies, etc. So buying that will be called as the implementation of the portfolio projects. Then seventh step is what? To evaluating and revising the portfolio. Continuous monitoring the performance of such kind of stocks or such kind of financial assets is needed in order to reduce your risks here. Then last step is what? To rebalance the composition of the portfolio. Always rebalancing it, that means selling off such kind of financial assets which is having the higher risk, and reinvesting that into some other kind of better investment portfolio, and it's a kind of a cycle. So buying, selling, buying and selling, it's a kind of a cycle where you can, after you've analyzed all of that, and you can make a mixture of such kind of capital assets, and you can maintain your capital, and you can increase your capital after a period of time. So these are the basic steps for managing your portfolio. So construction of an optimal portfolio using the method called sharp single index method. Okay, so under that, first is selecting the securities. Okay, choosing a set of securities, that is stocks, bonds or other assets that you want to include in your portfolio. So these securities should represent the diverse mix of asset classes and industries to reduce the specific risks. So as I was been telling in this session, that you should not just only invest on one kind of an investment project. There should be a mixture of all of the investment projects, so that you can get the maximize the returns and reduce your risk. So you have to be very careful regarding selecting of such kind of assets, that is stocks, bonds, debentures, mutual funds, insurance policies, for fixed deposits, etc. You can also go for money market instruments and capital market instruments based on the performance of such kind of stocks in the stock market. So next step is what? Calculate the historical returns to analyze the previous past performance of such kind of industry or company or stocks will be useful to analyze what will be the next performance in the, or you can forecast the next coming performance of the stocks or industry or the businesses. So calculate the historical returns of each selected security over a specific period, typically using the daily, monthly returns, or you can also take the yearly returns, and to split into the dividend, stocks and other corporate actions. What kind of managerial actions the businesses have made or industrial have made. So what is their dividend percentage? So how many stocks they are holding? So what is their profit earning ratio? All these are important here to analyze. All these are technical analysis that you need to make in order to build a optimal portfolio. Next step is here what? Calculate the market index returns. So that means it is determining the suitable market index returns, such as S&P 500 for US stocks, or for India you can take BSE 30. So based on that you can make an index of the, analyze the index of such market, and you can analyze the index points of the relevant country where you are staying. Okay, so in India we have got Bombay Stock Exchange. So under that you can make the index prices or indexes of such kind of stocks, how the market have been performing over the period of time. So next is calculate the covariance matrix. So calculating the covariance matrix of returns of the selected securities. The covariance matrix measures the relationship between the returns of different securities and helps the assess of diversification benefits. So calculation of the risk and return matrix, that is covariances matrix. So that means covariance is the relations between the returns and the and risks of the such kind of securities, and analyzing the what is the maximum returns that the securities are getting, and what is the risk percentage that you are going to face in such kind of securities. So that is the fourth step, that is calculating your risk and return analysis on the stocks or securities that you are going to make. So fifth step is what? Calculating the beta coefficient. So calculation of the beta coefficients, like we have done in the previous slides, or I mean in the previous sessions, that is we have calculated of unit 3, that is risks and returns. So calculation of alpha and beta coefficients. So calculation of beta coefficients for each security using the covariance matrix and market index returns. Based on that, the sensitivity of security returns has been analyzed and movements of the market index will be identified. So based on the beta and alpha calculations, you can analyze the market movements, and you can also analyze the price movements of the stocks in a industry, or in case of securities or businesses, etc. So next step is what? Estimate the expected return. So after you have calculated the alpha calculations and beta coefficients of the risks, or the depending upon the portfolios, next is what? To estimate the expected returns of it. So you can find out through the percentage analysis of the covariance between the portfolios. Like you have to select two types of portfolios, or any number of type of portfolios you want to invest on. So you have to calculate the alpha coefficients and beta coefficients. Then you can get the percentage of the risks and returns of the portfolio. So based on that, you have to select the expected returns of those two portfolios, which you find it better now, a percentage of the returns. So estimating the expected returns for each security based on the historical data, analysis of forecasting, economic outlook and other relevant information is important here. So this steps involves in considering the factors such as earnings growth, dividend yield and market trends. So based on all these kind of portfolios analysis, you can analyze the expected returns that you're going to get. So next step is what? Calculating the systematic risks. Okay. So calculating the systematic risk, that is regarding the market risk for each security using the beta coefficients and market index returns. So systematic risks reflect the proportion of security risk that cannot be diversified anyway and is related to the overall market movements. So analyzing the systematic risk. So we have got two types of risks, that is systematic risk and unsystematic risk. Unsystematic risks are always uncertain kind of conditions, whereas systematic kind of risk where you can analyze or forecast the risks or forecast the what kind of market indexes changes in the prices movements can be analyzed. So you can analyze based on the historical graphs, data points, market indexes of the previous data. So next step is what? Construct the efficient frontier. So using the sharp single index method, construct the efficient frontier which represents the set of optimal portfolio that offer the highest expected return of a given level of risks. So after all these kinds of steps, you have analyzed, calculated the beta coefficients, alpha coefficient, calculated the risk returns of a particular portfolio. Then here constructing the efficient kind of a portfolio based on the risk percentage and the return percentage. So using this kinds of Sharpe's index model, so you can make a optimal portfolio management here. So next step here, selecting of the optimal portfolio. So identifying the optimal portfolio from the efficient frontier based on the risk tolerance, return objectives and investment preferences. So these three are important based on your risk percentages, then objective regarding your financial objectives and regarding the investment preferences. So that means how much investments that you are able to make on the different projects. So based on that, an optimal portfolio is been selected and it has been maximized with the help of the Sharpe single index ratio, and it will be measured in case of risk adjusted returns and indicates how much excess returns and investment generates per unit of the risk. So it is a kind of mathematical calculation. So based on that, you can analyze the excess return of an investment based on the risk percentage that you are going to get. Then here the last step is what? Monitor and rebalance of the portfolio. So continuously monitoring the performance of your portfolio and rebalance as needed to maintain a desired asset allocation and risk return profile. So rebalancing involves buying or selling or assets to bring the portfolio back to its target weighed on based on the market movements and portfolio objectives. So continuously monitoring the performance of the portfolio and rebalancing is just nothing but buying and selling of such portfolios which are having the which if you face it, they're having a high risk, you are going to buy it, and if you're facing that there is a chances of improvement of the particular portfolio or stocks or securities in the market, you are going to buy it. Okay, so based on that, you are going to select the portfolio, continuously buying and selling of such kind of securities, and you can monitor and rebalance your overall portfolio management. So this is how you maintain your portfolio based on the index method, that is Sharpe's index method. So next is portfolio performance evaluation. So this refers to the evaluation of the performance of an investment portfolio. So it is essentially the process of comparing the return earned on a portfolio with the return earned on one or more or other portfolio or a benchmark portfolio. So it is about like comparison of your current portfolio with your previous portfolio, how much you have earned, how much percentage of risk is there, how much percentage of returns that you have earned on the different portfolios that you have invested, or you can take any kind of benchmark portfolio and you can make a comparison of those. So portfolio performance evaluation essentially comprises of two functions, that is performance measurement and performance evaluation. So it is containing the two types of functions, that is called measuring the performance and evaluation of the performance. So need for performance evaluation. So it is needed for appraisal of the performance. So whether the investment activities carried out by individual investor or through mutual funds or through any kind of investment companies. So different situation arises where there are such kind of situations where it is needed to analyze the performance of the portfolio. So we'll see what are those. Under that, first is self evaluation. So whether individual is an investor or a kind of any kind of activity that has been taken on their own, so the investment decisions are taken by them. So self evaluation are kind of an evaluation techniques that are being invested or maintained by a single individual on their own. So they construct and manage their own portfolio securities. In such situation, an investor would like to evaluate the performance of his portfolio in order to identify the mistakes committed by him. So the self-evaluation will enable to improve his skills and achieve better performance in the future. So based on the investments that he have made, how much returns have got, so what is the better kind of opportunities that he is going to have, self-evaluating and self-analyzing of the investment decisions you have made will be rewardable with the higher kind of risk, and as well as you also will be having the skill to analyze your market. So next is evaluation of the portfolio managers. So it might be of any mutual fund or investment company, usually creates different portfolios with different objectives and aim at different sets of investors. So each kind of a portfolio may be entrusted to different professional portfolio managers who are responsible for the investment decisions regarding the portfolio entrusted to on each of them. So in such situations, organizations would like to evaluate the performance of each portfolio so as to compare the performance of the different managers. So why one more need is what? If you are being hiring any investment manager or investment broker, so it is important to analyze the how much portfolios a particular manager is been maintaining and how much performance actually the other managers are getting or other stocks are getting. So basically the comparison is here is important to evaluate the measuring effectiveness of the portfolio investments that the investors have been made. So next need is here is what? Evaluation of the mutual funds. So investors and organizations desire for placing their funds with mutual funds would like to know the comparative performance of each so as to select the best mutual fund or investment company. For this, evaluation of performance of mutual funds and their portfolios becomes the necessary. One more need why we need to do the performance evaluation is what? To analyze the mutual funds or to analyze the different portfolio projects that we have got. So it is important to have a comparative performance of such kind of mutual funds or such kind of projects in order to select the best kind of a project, which always will be helpful to the investors in having the better evaluation and better decision makings in case of the investment decisions or investment portfolio projects that they are going to make. So this is the need why we need to analyze the portfolio performance evaluation. So in order to make a better decisions, investment decisions especially, and to analyze the future market. So how much the current portfolio is getting and how much the future predictions can be made with the help of the evaluation methods. So these are the topics that we have discussed today. In today's session, we have basically learned about all the important concepts about the portfolio management. So why it is important, why you need to manage the different portfolios, that is a mixture of different capital assets. Why? Because we need to have more money so that you can enjoy your after your working age, that is your retirement age. This is for the individuals. Then if it is for the businesses, so they will be having the financial goals that needs to be meted. So that's why investing on different kind of portfolios is very important here. So all these concepts that we have discussed today are being important for your final examination, and overall, like whatever the sessions that we have made in the previous classes also. So all these you are going to learn because investing into the kind of different projects or portfolios is very much important here. So which will help you to gain or to get more money. So these are the concepts that we have discussed in this semester. So I request you all to brush up all your fundamentals, be pakka or be 100% sure with your basics, so that you can understand the future concepts as well. With this, I will take your leave. So I'll meet you next time. Thank you so much.